In the previous video I talked about trading strangles, option strangles. However, strangles are very high risk trades. Iron condors are similar trades, but they cap the risk. So they're quite a bit safer in that regard. At least you know your maximum risk ahead of time. And so anyways, I'm going to show you one here today. Take you through an example. Okay, so we're going to look here at Apple stock. Alright, so basically what we're looking for in an iron condor as a seller, we're talking about selling these now. We're talking about selling strangles or selling iron condors. What we're looking for when we're selling an iron condor is a range, a stock price range that we believe the stock will remain inside of. Okay, so let's look at Apple here. Let's say it's trading at 253 right now. Let's look at this recent low. Say, let's call it, it's at 212. We'll just call it 215. So let's say we're looking at that as our low. We don't think it's going to go below that price. Okay, in the next couple weeks, let's just say we're looking at a time frame of 2 weeks, and we think it's going to stay above that low. It's going to hold that low. Okay. On the upside, however, we also think it's not going to go above the 50-day moving average. It might pop through the 20-day, but it's not going to go through the 50-day. Okay. So that's at 295. So we're looking at the 215, 295 is a range we think it's going to stay in. Okay. That's pretty wide, right? Of course, right now we're in, as I shoot this, we're in the midst of a global pandemic, so anything could happen. However, let's pretend this is normal times or somewhat normal times. We think that's a safe enough range. We wouldn't expect it to go outside that range. Okay, so let's say we want to profit off of that with options. Okay, what we're going to do here, let's pop up the April 9th. Those are 15 days away. Okay, the expiration is in 15 days. We said 215 for the downside. 215 puts. We don't believe it's going to go through there. We're going to sell those. And we're looking at the 295 as our upside. We don't think it's going to go through there. We're going to sell those. Okay, if that's all we did, that would be called a strangle. If we sold the put and sold the call, we'd be selling the strangle. We could collect $5.73 for taking that risk. Let's just move that to $5.75, and we could collect this price for taking the risk of selling these two options. Essentially, what that would do is move our break even down $5.75 below this strike or above this strike. So somewhat basically around 210 to 300. Inside of there, we would be okay. We would make a little bit of money. Okay, our maximum profit, as long as the price stayed between 215 and 295, would be this full premium. We would collect the full premium. It would go from $575 down to 0 at expiration. We would collect $575. Okay, but our risk at this point is essentially unlimited. Let's say, the pandemic is cured, miracle cure comes out, and Apple announces, I don't know, they invented a new super robot that does, I don't know what it would do. But anyways, the stock price goes to $400, okay? Right now, you'd be at risk of $105. If it went to $400 at expiration, you'd be at risk for $105 minus this puny $5 that you, $5.75 that you collected in premium, okay? Your upside risk is unlimited. Downside is practically unlimited as well. Okay, let's say the pandemic just is horrible, continues to get worse, and Google or Apple price stock price just falls to $100. Okay, we need to eliminate that risk. Okay, so one way to do that, here's how we're going to do it. It's called an iron condor. We're going to turn this into an iron condor by buying a lower strike put and buying a higher strike call. Okay. So what we can do here in this case, let's say we can buy, let's do the 205. We're going to buy a 205 put, and we're going to buy a 305 call. Now you can see what happened over here. The price just went down to 197. We were at 575. Okay, now I'm going to just round this up to $2. Okay, so we were at 575 if we were just selling a strangle. Now we're down to collecting just $200 per iron condor. Okay, But what we've done is we've capped our risk. Our risk is capped now at $10. The difference between these two strikes. Okay, if the price of the stock crashes, doesn't matter if it goes to 200 or it goes to 100, our risk was capped by this spread. Okay, this is a put spread. The $10 strike price difference, that's our maximum risk. We already collected $2 for the spread itself, so our maximum risk is $8. It's $800. Our maximum profit is $200. Same thing for the calls, obviously. If the price of the stock goes to 310, or it goes to 400, doesn't matter. Our risk was capped by this $10 call spread. Okay, you can limit this as much as you wanted to, or widen it as much as you wanted to. You're just kind of figuring out how you want to manage your risk effectively. Okay, so basically what's going to happen is if the stock over the next 2 weeks, let's say at expiration, it settles at right around here, 250, 240, 260, anywhere in this range of 215 to 295, doesn't matter. You're going to collect your full $2 in premium. You collected $200 in premium. It's going to zero. Okay, along the way, this as the days go by, that premium is either going to go up or down along the way. If the stock price suddenly starts to fall really fast, let's say in the next 2 days, all of a sudden it's dropped to 225, the price of this spread is going to go up. Okay, so you're going to be losing money if it's a sudden sharp move, and you're going to be making money if it just kind of lingers in this range and isn't really doing much. Okay, and that's the basics of an iron condor. Trying to think if there's anything else I can discuss on this. I really don't think so. Basically, all it is a put spread and a call spread. Your risk is defined by the width of the spread, and the price that you sell it at is a premium. You're going to collect that premium when you sell it, and then at some point you're going to either buy it back. You're going to buy it back in. You're either going to buy it back in, higher or lower as it goes, or at expiration, if it's between 215 and 295, you will just let that go to zero, and you'll collect your full premium of 200. That's it.
Thanks for watching, and don't forget to hit that subscribe button.